Welcome to vTalkInsight, Market Drivers Daily for February 23, 2026. Tariff whiplash, geopolitical tension, and even a major U.S. blizzard are all hitting at once, turning today into a stress test for risk assets and global supply chains. Let us start with the evolving trade war, where markets are reassessing whether the recent legal shock really means a lasting reprieve from high tariffs. The core story in trade today is that the apparent relief from earlier court rulings has morphed into tariff whiplash rather than a clean reset. Emergency tariffs have been removed in some areas, but new measures, including a global 15% rate under temporary authority, keep effective tariffs elevated and policy signals noisy. That combination sustains uncertainty around inflation, growth, and corporate pricing power instead of drawing a line under the trade war. Legally, the administration is leaning on Section 122 authority, which allows tariffs for only 150 days unless Congress extends them. At the same time, Supreme Court decisions have opened the door to potential tariff refunds that could reach roughly $170 billion. But any cashback is likely to be slow and heavily litigated. Companies such as major retailers and industrials remain in limbo, unsure whether to assume high tariffs will be rolled forward under other statutes like Section 301 and 232, or whether some relief will eventually arrive. For the macro outlook, economists now expect only a modest reduction in inflation from tariff rollbacks, while growth headwinds persist because the new measures keep costs elevated. Many businesses are unwilling to cut prices that were previously raised in response to tariffs, as they wait for clarity on whether 15% global levies become the new floor. That stickiness means consumer prices are likely to stay high even if headline tariff rates edge lower. Markets are responding with a cautious tone. S&P futures are down around 0.5%. Global equity indices are under pressure, and risk-off flows are lifting gold toward record highs as a preferred hedge against policy volatility. Under the surface, the trade shock is reshaping growth and sector dynamics rather than simply derailing the cycle. On the downside, persistent tariff uncertainty is weighing on capital expenditure and hiring outside the technology complex, with last year's non-tech investment turning negative despite a soft landing backdrop. Import-heavy consumer names, including apparel retailers where margins have already taken hits of 100 to over 200 basis points, face renewed cost pressure, as do autos and generic drug makers that could even see supply risk if low-margin producers exit the U.S. market. In contrast, emerging Asian markets and currencies, as well as partners like Canada and Mexico that receive meaningful tariff relief, are positioned as relative beneficiaries of shifting trade flows and production. There's a counterview that deserves weight. Several analyses suggest the effective global tariff rate is likely to drift lower over the next 6 months, with recent changes having only limited impact on aggregate revenues and bond markets staying relatively calm. The argument is that, with the most extreme legal tools struck down, tariffs may become more rules-based under trade statutes that require investigations and congressional input, reducing tail risk even if headline rates stay high. For now, however, policy uncertainty remains elevated, with the estimated probability of adverse economic tail scenarios rising from about 10 to 30%. Key watch points are the 150-day clock on Section 122, the pace and scope of legal challenges, and how upcoming talks with China and Europe evolve. Those trade negotiations sit alongside a second major source of risk premia today, which is the geopolitical front. Geopolitics remains dominated by the U.S.-Iran standoff, which is injecting a persistent risk premium into energy and safe haven assets, even as spot prices move in unusual ways. The U.S. has assembled its largest military presence in the Middle East since 2003, maintaining fully operational forces that signal credible capability for significant strikes if diplomacy fails. At the same time, nuclear talks in Geneva are entering a third round, and rumors of a potential deal are circulating because both sides have incentives to avoid an uncontrolled oil price spike that would hurt U.S. consumers and Iran's already stressed economy. Oil markets are caught between elevated risk and ample supply. Despite a roughly $10 per barrel risk premium linked to Middle East tensions, a persistent global oversupply has kept average Brent forecasts anchored near the low 60s this year, and prices have actually eased on some sessions, even as rhetoric intensified. Scenario work highlights that a temporary closure of the Strait of Hormuz, which handles around a quarter of seaborne oil trade, would likely trigger a sharp spike in prices and volatility. But a prolonged blockage is viewed as highly unlikely because it would inflict severe damage on exporters and importers alike, from Gulf producers to major Asian buyers. Gold is where geopolitical stress is showing up most clearly. The metal has gained about 6% in just 4 sessions and is approaching record territory as investors seek protection from both tariff and conflict risk. Safe haven demand is also supporting U.S. Treasuries and, at times, the dollar, even as other episodes see the greenback weaken when markets worry about U.S.-specific growth fallout from storms or sanctions. Bitcoin, by contrast, is trading softer despite constructive regulatory news, underlining that, in this environment, classic havens are still preferred over higher beta alternatives. Beyond the Gulf, geopolitical stress is visible in Europe's energy and policy architecture. Hungary is threatening to block all European Union decisions on Ukraine, including a sizable loan package, until Russian oil shipments through the Druzhba pipeline resume, underscoring how vulnerable European supply remains to infrastructure and political shocks. At the same time, trade and digital policy tensions between the U.S. and Europe are increasing, with the European Union pausing or suspending work on trade agreements as it waits for clarity on U.S. tariff tools and global tax rules. These cross-currents raise the risk that geopolitical disputes spill further into economic and regulatory domains, complicating the backdrop for multinational corporates. Balancing the scenarios, the base case implied by current pricing still leans toward limited strikes or a fragile diplomatic accommodation, rather than a sustained regional war. Iran appears determined to offer only minimal concessions, aiming to prolong talks and secure sanctions relief, while keeping elements of its nuclear and missile programs intact, and domestic unrest has not yet threatened regime control in a way that would dramatically change strategy. Gulf states are quietly urging Washington to avoid escalation, fearing direct security threats and disruption to exports through Hormuz, and that pressure acts as another brake on the most extreme outcomes. Even so, markets have not fully priced a serious breakdown in talks. Any move toward military action or new energy sanctions could force a rapid reset in oil, credit spreads, and high beta assets. That geopolitical overhang feeds directly into real-world logistics and costs, which are also being stressed by today's more mundane, but still material, supply chain disruptions. Supply chains are being squeezed from 2 directions today: policy volatility and severe weather. A major winter storm across the U.S. Northeast has led to roughly 10,000 flight cancellations, widespread travel bans, and a shutdown of key transit links, including a full suspension of Long Island Railroad services while snowdrifts are cleared. The New York Transit Authority is running reduced subway and bus schedules, but operations are constrained by snow accumulation and staffing challenges, and similar conditions in the Northwest are further disrupting movement of people and goods. These physical disruptions have immediate economic and market effects. Regional commerce is slowing as consumers stay home, logistics bottlenecks delay deliveries, and corporate activity is interrupted, all of which may show up as temporary softness in high-frequency data. Natural gas futures have spiked on heating demand, signaling near-term upward pressure on regional energy prices, while the dollar has at times weakened as markets factor in potential drag on U.S. growth and even lighter trading volumes that can distort short-term price discovery. Overlaying the weather story is a more structural supply chain shock from tariffs and regulatory uncertainty. Tariff rates have been adjusted multiple times within just a day and a half, with the latest move to 15% global levies under Section 122, making it exceptionally hard for importers to plan inventory, pricing, and hedging. In apparel, companies such as Gap, Abercrombie & Fitch, and American Eagle have reported annual margin hits on the order of 1 to over 2 percentage points from tariffs. And while recent relief may trim tariff costs by 20 to 50 basis points, few are cutting shelf prices while policy direction is unclear. Other sectors tell a similar story of strain and adaptation. Consumer stocks like VF Corporation are trading lower on renewed trade headlines, while automotive names such as Mazda face another round of cost pressure as the 15% global tariff bites into import-heavy models. Tariffs on generic drug imports from countries, including China, raise the risk that some low-margin producers simply exit the U.S. market rather than reshore, potentially creating shortages in essential medicines. By contrast, metals and mining companies and parts of the copper complex have already reorganized operations to build resilience after earlier tariff shocks and are maintaining investment momentum despite the latest policy twists. Looking through the near-term noise, the common thread is a gradual rewiring of global supply chains. Persistent trade uncertainty is encouraging diversification toward emerging Asian manufacturing hubs, while Canada and Mexico appear to benefit from relative tariff relief and proximity to U.S. demand. For Europe, German exporters face incremental headwinds from U.S. EU trade uncertainty and a firmer euro, but diversified end markets and strong intra-European trade soften the blow. Counterarguments emphasize that some recent global tariff changes may have only limited impact on effective rates, and that weather disruptions are inherently temporary, with activity often rebounding once conditions normalize. Key watch points now are how quickly U.S. transport networks recover from a storm, whether natural gas prices settle back, and what corporate guidance says about inventory, lead times, and sourcing strategies. All of these will shape how durable today's risk-off tone proves to be. To wrap up, today's tape is being driven less by fresh economic data and more by overlapping policy and logistics shocks. Tariff policy has shifted from a legal reset to a messy, high-uncertainty regime that keeps cost pressures alive and leaves CapEx decisions on hold, even as some partners like emerging Asia and North America start to look like relative winners from trade diversion. Geopolitical tensions, especially around Iran and European energy routes, are sustaining a risk premium in oil, gold, and volatility, while severe U.S. winter storms add another layer of disruption to transport, energy, and near-term growth readings. Watching how Section 122 tariffs evolve, whether diplomacy contains Middle East risks, and how quickly supply chains normalize after the blizzard will be central to judging whether the current risk-off tone deepens or fades. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.